So in the last session, we discussed about the different accounts which we prepare in this particular chapters, and today we're going to discuss about the final account second part. In this particular part, we already discussed about the summary and objectives and introduction in the last session. And we need to know in this particular session that how we particularly treat the spatial items relevant to company's final account. That will be like the preliminary expenses on issue of shares and debentures, issue on discount on issue of share and debentures, then premium on issue of shares, call in arrear, call in advance, forfeited shares, then depreciation of fixed asset, provision for taxation, dividends, interest on debentures, transfer of reserve, and balance of P&L account. Then we prepare the final account. So basically, first of all, we need to about the treatment of spatial items. What spatial items we need to consider basically? First one is preliminary expenses. Preliminary expenses are those expenses which we done while we are making a particular company or enterprise, like the cost of printing the memorandum, article of association, fees paid to lawyer, drafting various documents like stamp duty, then registration fees, filing fees payable at the time of registration of the company. So all these particular accounts will be debited to preliminary expense account and treated as capital expenditure. So they have to be written off within a period of 3 to 5 years, and the actual annual amount that will be decided to be written off is debited to P&L account. That means the profit and loss account. And the balance of preliminary expenses account has to be shown in the asset side of balance sheet and as a separate item under the heading of miscellaneous expenditure and losses. For example, a particular company which has incurred a preliminary expenses amounting to rupees now 9,000, and then it is decided to write off the amount in equal proportion over 3 years. That means at the end of first year it will be charged 3,000 to P&L account, and the rest of 6,000, that means 9,000 minus 3,000, so it left 6,000. It will be shown in the asset side of the balance sheet. Then we particularly debit the balance of 6,000 in the preliminary expenses account, and it will be carried forward to the next year. Then in the second year we again charged 3,000, and the remaining balance of 3,000 will be shown in the asset side of the balance sheet. And in the third year 3,000 will be charged again, and it is gone to P&L account, that will be profit and loss account. And the preliminary expenses account will be closed and will no longer appear in the balance sheet, because in the different years we actually write off this expense 3,000. So the total is 9,000. We write off it in a 3 years, so it will be 3,000, 3,000, and then 3,000 in the last year. Next one is expenses on issue of shares and debentures. When we basically issue the debentures to the public, or we actually issue shares to the public, so in that particular category there are some expenses which we need to bear in that particular issue of shares and debentures. So when the shares and debentures are issued to the public, so the company incur expenses by way of underwriting commissions, brokerage fees. Then underwriting commission has to be paid by an individual, a firm, or an institution which undertakes to subscribe to that part of the shares or debentures which may not be subscribed by the public. So if we are talking about commission, so it is like a fixed percentage of the issue price of the shares or debentures which will be underwritten. If we are talking about brokerage, it will be paid to the institution, maybe appointed manager to the issue, for which fees are payable and fixed as a percentage of the issue price of the shares or debentures. Then the maximum rates at which the underwriting commission brokerage fees can be paid by any company has to be laid down in the Companies Act and prescribed by a government order. So all the expenses on issue of shares, debentures are capitalized and normally charged to the P&L account over a period not exceeding 5 years. That means the maximum period for the write-off of these expenses will be 5 years, and the underwritten of sorry the writing of amount has to be shown every year on the asset side of the balance sheet as a separate item under the heading of miscellaneous expenditure and losses. Here we have an example for it, that the treatment of the above mentioned item in the company final account, like a company was registered in January 2021 with an authorized capital of 1 lakh. Then we have a equity, these are the equity shares of rupees 10 each. Then we have a preliminary expenses of rupees 9,000. In that particular company, a company issued 50,000 share to the public. Then issue was underwritten by a firm for which the company agreed to pay commission at rupees 2.5% of the issue price. So the application which were received for 45,000 shares from the public, which were duly allotted and fully paid. So the company decided to carry forward the preliminary expenses and the expenses on issue of shares to the next year. Then how will the transaction be reflected in the balance sheet for 2021? So before preparing the balance sheet of the company, we should note down the following points. Like first one is public subscription being less than the number of shares issued, the balance of shares were to be taken up by the underwriter, and the amount which will be payable to the underwriter on account of underwriting commission was rupees 12,500. That will be 2.5% on 5 lakh. That 5 lakh will be our issued capital. And the underwriter has to pay rupees 50,000, that will be 5,000 shares of rupees 10 each to the company, and the net amount that will be due to the company under the underwriter was rupees 37,500. However, underwriting commissions payable should be treated separately as a deferred revenue expenditure or loss. Then we have a preliminary expenses like expenses on issue of shares including underwriting commission, were decided to be carried forward to the next year. So the possibly because of operations were not it started. So if we check the balance sheet, in the liability side, we will have the share capital. First one is authorized capital, 1 lakh equity share of rupees 10 each, that will be 10 lakh rupees. Then we have a issued capital, 50,000 equity share of rupees 10 each, 5 lakh. Then we have a subscribed capital, 50,000 equity share of 10 each, 10 per called up and paid, that will be 5 lakh. So in the asset side, we have current asset in the cash in hand and bank, that will be 4,78,500. Then we have a miscellaneous expenditure or losses, like preliminary expenses 9,000, which are given in the question. Then we have underwritten commission, that will be 12,500. So the balance of both the side will be rupees 5 lakh. Next one is discount on issue of shares and debenture. First of all, if we are issuing shares and debenture, so it's our choice that we can give discount to the shareholder or the debenture holder, but it is like a capital loss for the company. So basically, in the case of discount allowed on issue of shares or debenture, that will be charged from the capital, and it is like a capital loss for the particular company. And the amount which is realized on issue, that will be less than the face value of the security. Means if the face value of a particular security is rupees 10, then if you are giving a discount of rupee 1, then the face value will be 9. So both the values are different if you are giving a discount. and the amount of discount may be written off by charging it against the capital profit if there is any, or otherwise charged from the P&L account over a period of 3 to 5 years. So the amount which is not written off is carried forward to the next year and shown in the current year balance sheet as a separate item under the heading miscellaneous expenditure and losses. So the discount on issue of shares and debenture is also shown in the miscellaneous expenditure and losses, or the discount on issue of shares or debentures can be treated as a deferred revenue expenditure also if the company is treated it as a preliminary expense in the same way in the final account. Next one is premium on issue of share. Like a particular company can issue a share on discount, in the same way they can issue a share or debentures on a premium basis. Sorry, only the shares can be issued on premium basis. Like if the face value is rupees 100 and we are selling it on 102 or 104, so the amount which is 2 or 4, that means 100 minus 102 or 100 minus 104. So the amount will be 2 or 4. That will be known as the premium of shares. And for that particular premium, we need to make a different account, a separate account that will be known as share premium account. And it is like a capital profit. Discount is a capital loss, but the premium is like a capital profit for a particular company, which can be applied to write off capital expenditure or capital losses like preliminary expenses, then underwriting commission, brokerage, discount allowed on the issue of shares and debenture, and the premium payable on the redemption of preference shares or debentures, then the credit balance of share premium account that will maybe remain after meeting any of the above expenses or losses is shown in the liability side of the balance sheet as a separate item under the heading of reserve and surplus. We have an illustration to understand this particular premium that a Shakti Limited raised from the public 6 lakh by issuing 50,000 equity share of rupees 10 each, and they are actually giving it to the public at rupees 12 per share. So the underwriting commission was agreed 2.5%, that will be 7500, sorry, 2.5%, and 7500 will be the brokerage of to the firm to stock broker. From the basically above mention, we need to make a particular balance sheet. So first of all, if we see the premium on a particular share, that will be rupees 2. So basically in this case 10 minus 12, so the amount of premium will be 2 per share, and the amount of premium that will be received 1 lakh rupees 2 per share on rupees, sorry, on 50,000 share, and we have a underwriting commission 2.5%. So we charge it on 6 lakh, that will be our issued price which is given in the question. So 6 lakhs multiplied by 2.5%, so the amount will be 15,000. So the total amount of issue expenses and the underwriting commission is rupees 15,000. Then we have a brokerage of 7,500. We add up and the total expense will be on the issue price 22,500. So this particular amount will be charged to the share premium account, which will be credited of rupees 1 lakh, and the issue expense will be fully written off through the share premium account, and the credit balance will be 77,500. How? 1 lakh minus 22,500, so we get 77,500. How we can show it in a balance sheet? First of all, we have a share capital, whatever the authorized capital, we need to mention it. Then we have a issued and subscribed capital, like 50,000 equity share of rupees 10 each, that will be fully called up and paid 5 lakh. Then we have a reserve and surplus share premium account rupees 1 lakh. Then we deduct the expenses on issue of share 22,500. Then we have 77,500, the total one. Next heading is call in arrear and call in advance. If we are talking about call-in area, if we issue the shares to a particular person and that person is unable to pay the calls money or any allotment money, that means if a person needs to pay the total rupees 10 on 100 share but he paid only rupees 5 or rupees 6 from the 10, then it will be known as call-in area. And in the case of call in advance, when a particular person already paid all the installments in advance, like he need to pay rupees 2 on application, 3 on allotment, then 2.5 on first call and 2.5 on second call, but the whole total rupees 10 he paid on the at the time of application or allotment, that means he paid it in call in advance. So that will be known as call in advance. So the particular call in advance will be shown in the asset side and call in area will be shown in the liability side. Then we have a forfeited share. Forfeited share, the particular subscriber who did not pay the call money or any allotment money, that means that particular person did not pay the total amount to us, then that particular shares will be forfeited and the amount will be transferred. Sorry, the amount will be transferred to the forfeited share account, and these shares can be basically reissued to the other person or not reissued by the other person. It depends on the situation of particular company what they want, and then the total amount will be transferred to the capital reserve account in the under the heading of reserve and surplus. We have a basically example for it, that a particular company, just give me a second students. So in this example, basically, we have a particular company in which we are basically have a forfeited of a rupee 100 share of rupees 10 each, on which 5 basically. So basically, they paid on application allotment money and a call money of rupees 5 per share, which is basically not paid. So in this case, we have a 500 that will be credited to forfeited share account, and on the forfeiture of shares, let us assume that 60 shares were reissued at a discount 3 per share. So in that particular case, that will be the discount that will be allowed on reissue, that amounted rupees 180 against rupees 300, that will be rupees 5 per share. So originally the which we receive on these particular 60 shares, so the amount credited to forfeited share account will be reduced by rupees 300, of which 180 will be transferred to share capital account, and rupees 120 that will be capital profit transferred to capital reserve account, and the remaining balance of 200 in the forfeited share account, that will be representing the amount received on 40 shares which are not yet reissued, that will be carried forward and shown on the liability side of balance sheet as an addition to the amount of subscribed and called up capital. Next heading will be the depreciation on fixed asset. Depreciation means when we buy a particular fixed asset, each and everything will be depreciate. That means, like if we purchase a particular car, it will be depreciated. If we buy a furniture, that will be depreciated. That means whatever asset we have, fixed asset we have, like plant and machinery, each and everything will be depreciated after a certain time period. So by what amount the depreciation will be charged, that will be given in the basically the blocks given in the income tax act. From there we can find out how much depreciation we need to charge on what fixed asset. So basically that will particular depreciation will be debited, and that will be debited to the PNL account, and the amount of depreciation is accumulated from year to year in the depreciation account for each category of fixed asset. And then the trial balance prepared at the end of any year, that will be the total depreciation provided till the end of previous year, and appears at a credit balance. So this particular amount of depreciation provided for the current year, that will be added to it. Next one is provision for taxation. In the business, we already know that we need to pay a certain amount of depreciation at the end of the year. Uh, uh, Basically, what profits we are making, and what provisions are having a particular in the income tax act for the company or the enterprise. According to that, we need to pay the taxation. So for that payment, we will make a provision for taxation account, and it will be shown in the liability side of the balance sheet, and it will be shown under the separate item, and the subheading will be the provisions. So that will be considered as the current liabilities and provisions under the balance sheet. Next one is dividend. Dividend we need to pay to the shareholders at the time of profits. Dividend will be paid from the profits only, and if there is extra profit, we can basically give the extra profit to the shareholder. That will be known as the interim dividend, which is given in the mid of a particular year. That will be known as the interim dividend. So the dividend which we need to basically distribute among the shareholders, that will be known as the dividend, and it will be only given from the profit earning, a particular company which they are basically earn a profit, so that will be known as the dividend. Next one is interest on debentures. In the case of interest on debenture, we need to basically give the interest on a particular debenture holders on their debentures twice a particular year, half yearly, on the 30th June and 31st December, or 31st March or 30 September, whichever a company is following, and that particular interest given to the debenture holders till the debentures will be redeemed. And that will also known as the basically interest or debenture will give us a benefit in that at the time of taxation. We get a rebate in the income tax when we pay the income tax for the company. Next one is transfer to reserve. Whatever profits are left, that that particular part of a profit will be transferred to the reserve, and that will be known as the general reserve. Or if there is any specific reserve, that will be treated as an appropriation of profits, and thus it will be shown in the P&L account of a company. This amount is also added to the concerned reserve while preparing the balance sheet. Next one is balance of P&L account. In the case of balance of P&L account of a particular current year before appropriation, so the balance of P&L account brought forward from the previous year, that will be shown in the second part of the current year profit and loss account, and the final balance of profit is carried forward to the next year, and the amount will be shown as the surplus on the liability side of the balance sheet under the heading reserve and surplus. So the final balance of P&L account, that will indicate us a net loss, that will be debit balance as shown as a deduction from general reserve on the liability side. And if the net loss is more than the amount of general reserve, it will be shown on the asset side of the balance sheet, and that will be to the extent that will not be adjusted under the heading of miscellaneous expenditure and losses. Then we have an example to understand it, that a pro company carried forward 40,000 credit balance in the balance P&L account from the year ending 31st March 2020 to the next year. It made a further profit of rupees 2,80,000 during the next year, 31st March 2021. The following decision to the directors were to be carried out, and you are required to prepare the P&L account that will be below the line for the year ending 31st March 2021. Then show how the relevant items will appear in the balance sheet. So we have a basically P&L account that will be below the line of the year ending 31st March 2021. Like this, we can show all the balances and all the things which are given in the question. Then how we prepare the final account? In the case of preparation of final account, we have a P&L account and a balance sheet of a particular company, and figures of current year as well as of a preceding year must be given. So if there is no performance of P&L account of a company, there is a detailed legal provision about the information to be contained in this statement, and the P&L account must be present in the vertical or horizontal form. And in the similar case, the balance sheet will be shown in a prescribed form of performa, whether it is in horizontal or vertical form. So we can present uh, P&L account in a flexible form, that whatever performer we like, we can show it in that performer. But actually, that performer will be understandable to the others. That particular thing will be important. So, in that particular performer of a P&L account, like this, we have debit side and a credit side. Part one is for opening stock, then we add purchase in it. Then we deduct purchase return. We add carriage inward, wages, manufacturing expense. And on the credit side, we have sale, then we deduct the sale return, and we have a closing stock. In the end, we have a gross profit which will be transferred to the P&L account. So the gross profit CD, it become the gross profit BD. Then in the part two, we have general administrative. Then we have expenses like salary, rent, stationery, electricity, insurance. Then we have a selling and distribution expense like advertising, salesman, salary, commission, discount, bad debts, etc. Then we have a repair and maintenance, repair annual, depreciation, etc. Then we have a financial expenses, that will be interest rates, etc., net profit. Then we have a part 3 reserve dividend. And in the credit side, we have basically non-operating income like rent, interest, dividend, etc. And then we have a balance, BD or CD, or net profit from it. This is the performer. And this is the balance sheet performer, which they are in the liability side. We have share capital. Then we have a reserve and surplus, secured loan, unsecured loan, current liability and provisions. And in the asset side, we have fixed assets, investment, current asset, loans and advances. Then we have miscellaneous expenditure. So, like this, you will get a question in your examination that they give you a balance sheet in which there are so many assets and liabilities are there, and they give you some additional informations also, like the authorized capital 3 lakhs divided into 30,000 equity share of rupees 10 each, and a company offered 15,000 shares of public subscription, of which rupees 7.5 per share were called up. So basically like this you need to solve the illustration. This is your solution. Basically, you need to prepare the P&L appropriation account in which you have all the profits and loss and incomes. And then you need to make the balance sheet in which you need to show the liability side and asset side, in which you have share capital, issued and subscribed capital. And on the asset side, you have a fixed asset and current asset. In the liability side, you can show the basically reserve and surplus, secured loan, unsecured loan from subsidiary, current liabilities and provisions. And on the other side, you have fixed asset, current asset. Then you have loans and advances, miscellaneous expenditure, and losses. In the same way, you have illustration 2. This you need to practice at your home. And if you have any query, you can ask in the next lecture. But these questions you need to practice at your home, which is given here. Same is 7.3. They give you this particular illustration from which you need to make the P&L account, that will be profit and loss account, and the balance sheet. So basically, this is your let's solve one illustration. I'll make you understand how you need to. So basically, let's take 7.2 illustration. In this particular illustration, we have different things like paid up capital, that will be 60,000 equity share of rupees 10 each, general reserve, unclaimed dividend, trade creditors, building at cost, purchases and sales, manufacturing expenses, establishment charges, general charges, machinery at cost, motor vehicle at cost, furniture at cost, opening stock, book debts, investment, depreciation reserve, advance payment of income tax, cash balances, directors' fees, investment and trust, P&L account, that will be from January 2020, staff provident fund. Then we have some additional information like from these balances and the following information, you need to prepare a company balance sheet as on 31st December 2020 and the P&L account for the year ended on that particular date. So the stock on December 31st, 2020 was rupees 1,48,680. Then we need to provide rupees 10,000 for depreciation on fixed asset. That will be rupees 6,500 for managing directors commission. Then we have 1,500 for the company's contribution of the staff provident fund. Then we have interest accrued on investment amounted 2,750. Then we have a provision of rupees 60,000 for taxes in respect of the profit of rupees 2020, which we need to consider necessary. Then we have a director's purpose, sorry, director propose a final dividend at 4% after transferring rupees 50,000 to general reserve. Then we have a claim of rupees 2,500 for workman compensation, which is being to be distributed by the company. Then we have a market value of investment as on 31st 12/20 amounts to 3,02,500. So first of all, we need to make a P&L account. So for the P&L account, first of all, we need to have a opening stock, first of all we check the debit side. So first of all we need to have the opening stock, then we need to add purchases. Just give me 2 minutes. So we have a opening stock, then we add purchases in it, manufacturing expenses, and on the left side, sorry, on the right side we have sales and closing stock. After from balancing both the sides, we get gross profit of rupees 2,666,000. After that, that gross profit will be transferred to the second part of the final account. Then in the gross profit we add interest on investment, and then we add the accrued interest. Then we on the left side we have establishment charges, general charges, directors fees, depreciation on fixed asset. Then we have a MD remuneration, contribution to provident fund, provision for taxation, and in the end, after balancing both the figures, we get profit for the year that will be transferred to the balance. As per the last year we have 16,848, then we have a profit for a particular year that will be 74,268. Then we on the left side we have a general reserve transfer 50,000, proposed dividend we have 24,000. From this total profit, in the end we have a balance CD of rupees 17,116. So from 91,116 rupees, you need to deduct 50,000 and you need to deduct 24,000. And in the last, you will have the balance CD of rupees 17,116. In the balance sheet, we need to show all the things which are given in the question. So first of all, we see the asset side. At the asset side, we have a building at cost, machinery at cost, motor vehicle at cost, furniture at cost, and we add all the things and we deduct depreciation which is given in the question, and we have the amount from the fixed asset 3,04,000. Then we have an investment of rupees 2,88,950. Then we have a current asset and loan and advances. In the case of current asset, we have a stock and trade at cost or market value, whichever is less, that will be 1,48,680. Then we have a book debt, and then we have a cash balance on our hand. Then we have a loan and advances, that will be accrued interest on investment and advance payment of tax. Then we have a miscellaneous expenditure, uh, which is zero in this particular question. So in the liability side, we have share capital, that will be authorized capital, and we have a issued, subscribed, and paid up capital, that will be 60,000, equity share of rupees 10 each. 6 lakh. Then we have a reserve and surplus, in which we have general reserve added during the particular year. The total will be 3 lakh. Then we have a profit and loss account, that will be 17,116. Then we have a secure, we don't have a secured loan and secure loan, but we have a current liabilities and provisions. Then we have a current liability and provision. In the current liability, we have trade creditors, unclaimed dividend, managing directors, remunerations. And in the provisions, we have provision for taxation, proposed dividend, staff provident fund, and we add the particular staff provident fund during a particular year. And both the sides will, we have 10 lakh 90,000. So basically, we need to balance both the side in the balance sheet, and we need to end up our question like this, which you, this particular performer you need to follow while you are writing your exam. So this is your final accounts. In this way, you need to prepare the final account. That will be your unit 7. Now let's move toward unit 8. Unit 8 is cash flow statement. So basically, cash flow statement means while we are doing a particular business, we are basically dealing with the cash only. Means in our business, somebody is giving us cash, or we are paying for something. That means we are giving cash to somebody. That means the whole process of cash inflow or outflow, for that particular knowledge of how much cash inflow or outflow we have done in a particular year, we will make the cash flow statement. In this particular statement, we show all the activities related to cash only, and no other activity will be mentioned in this particular statement. So from this statement, we just need to know about the cash activities only. None other activities we can understand from this statement. So it is also comes under the financial, to know about the financial position of a company. If a company is having a good profits from the cash flow statements and showing a good profits in a cash flow statement, then it will be considered as a good company, or otherwise it will not be shown as a nice company. So, in this unit, we need to understand the objective of this unit, introduction, why we need for cash flow statement and how it is different from other financial statements. Then we need to know how we can prepare a cash flow statement, like sources and uses of cash, and then ascertain cash from operations. Then we need to prepare cash flow statements, regulations relating to cash flow statements, cash flow statement formats, cash flow from operating activities. Then we have cash flow from investing activities and financing activities. Then we have a uses of cash flow analysis. Then we have a distinction between the fund flow and cash flow analysis. So, if we are just talking about the objective of cash flow statement for investors and stockholders, we need to show the importance and explanation of cash flow. Then we need to compare. Then we need to compare the cash flow statement and the other financial statements. Then we need to know the regulations relating to the preparation of cash flow statements. and how familiar with the methodology for preparation of cash flow statement and how important components of cash flow statements. And then we need to comprehend how cash flow statement can be used in real life for different decision making. So in the introduction, cash flow statements are required to be made according to the accounting standards 3, and now we have a Indian accounting standards also. So according to the Indian accounting standard, it will be 7 accounting standard which are generally accepted all over the world. In that accounting standard, cash flow will be as AS3, and in the Indian accounting standard, it will shown in the India AS accounting standard 7. And it is a basically a major development in accounting measurement and disclosure because it is relevance to financial statements user. So if we are talking about cash flow statement, it is simple and easy to understand, and it shows some kind of difficulty because it can manipulate the cash flow numbers, and to test the real profitability of the firm, we need to maintain the proper cash flow statement. Like if a company approaches a bank for a loan, so your company will normally highlight the profitability of your business as your strength, but the bank manager may not be sure how you arrived at the profit. So particularly when we read a lot of accounting related scams, the bank manager would like to examine whether you have actually earned the profit or not. And in the case of balance cash flow statement, we they can you sorry in the case of cash flow statement, it will be useful to examine and to know that the company is having a actual profits and not, and what percentage of profit a company or a firm is basically realized. So if we are talking about, in the other words, a company that particular shows high level of profits need not be liquid in cash, so the supplier of the goods will also be entrusted to examine the cash flow position of the company before supplying goods on credit. The investor who have no control or manager will also be interested in examining the cash flow of the supplement his or analysis on profitability of the business. So first of all, the point is that why we need a cash flow statement. So the basically basic condition of the cash flow statement is to know the cash activities which are running in a business in a particular financial year, and it will be divided in the three categories. First one is operating, and second one is investing, and third one is financing activities. So to know all the informations which are provided related to the cash receipt and cash payment during a particular year, that will be known as the cash flow statement. So the net effect of cash flow is provided under the different heads that will be namely, which I already told you, operating, investing and financing activities, and it help to users to find answers to the following important questions like where did the cash come from during the period, what was the cash used for during the period, what was the change in the cash balance during the period. Then we have two important uses according to the accounting standard 3 of the cash flow statement, that the cash flow statement which we are using is a conjunction with the other financial statements, and it provides us full information that will be enable users to evaluate the changes in net asset of a particular enterprise. Second one is historical cash flow information is often under used as an indicator of the amount, timing, and certainty of future cash flow, and it is also useful in checking the accuracy of past assessment of future cash flow, and it will be examining the relationship between profitability and net cash flow and the impact of changing prices. So basically, statement that will be issued by Security Exchange Board of India in 1995, that the cash flow statement is mandatory and a primary objective of requiring the listed companies to provide cash flow statement to investors, because they can basically tell us about the actual performance of the company related to profits and how they are using their funds in a particular year. So basically, you can read this first point. Just read this first point and try to understand it. I hope you just read it. So, like this, first one, second one is from Robert Morris. Please read it too. So next one is basically cash flow statement versus other financial statement. So in the cash flow statement, it is kind of different from other principal financial statements, and it basically have different ways to basically make. There are two methods, one is direct and one is indirect. In the case of financial statement, we have P&L account and the balance sheet, which are prepared using accrual accounting principles. That means the actual income which is accrued and yet not received, that will be added, that will be added to in the basically from in the profits. So in the case of cash flow statement, basically, there is a firm which is selling its product and it assumed that profit is realized, and the going it we need to assume as a going concern. So the firm will eventually realize it profits. So in the case of a cash flow statement, we need to prepare three activities which we already discussed. And in the financing, when we are checking the financial statement, we need to prepare P&L account and balance sheet. So we have these two different cases, in the case of financial statement and cash flow statement. This is the major difference between these two. So, in the case of P&L account, you need to show all the profit and losses which we are discussed in the unit 6 and 7. These are the financial statements. And cash flow statement, we will show you, I will show you in this way. So we need to summarize all the operating activity which are basically shown from the P&L account entries of a cash book, like sales, material, wages. Then we need to summarize all these. In the case of investing activities, we need to summarize all the asset side entries like purchase of fixed asset, sale of fixed asset, then about cash book. And in the final case, in the final case, we need to check the entries like borrowing, prepayment, fresh equity of cash book. And from all these activities, we will know about our cash flow, how much we are basically, how much cash is going out from our business and how much cash is coming in our business. So first of all, we have a cash flow statement under direct method. In this, first of all, the activity which we need to measure, that will be the operating activity. In this activity, we have cash collection from sale. From this, we deduct cash paid for raw material, direct labor, and overhead. Then we deduct cash paid for non-factory costs, that will be sales and wages, and other sales and administration. Then we have cash generated from operating. Then we add interest earned, and in the end we get net cash from operating activity. In the B point, we have investment activities like purchase of plant asset, short term investment. Then from these activities, when we add both the things, we get the net cash flow from investing activity. And then we calculate financing activity. In the financing activity, we have dividend paid, and we get the net cash flow from financing activities. Next one is net change in cash. That means we need to add all three, and in the end we have cash at the beginning of the year. We add the cash at the beginning of the year in the net change in cash, and we get cash at the end of the year. So like this, we need to make cash flow statement. Like they give us a profit and loss account. So you can check, this is your financial account, or I can say financial statement, where we have income and expenditures, and this is your cash flow statement, in which we have all the details which is related to the cash, whether it is from operating, investing, or financing activities. Next one is cash flow statement. That means, what is cash flow statement? So basically, the flow of fund, whether it is inflow or outflow, that particular inflow and outflow will change the working capital of a particular company, and that will be known as the cash flow. When we mention all the activities of cash, whether it is inflow or outflow in a particular statement, that will be known as the cash flow statement. Maybe it increases the working capital or maybe it decreases the working capital. So basically, we have a cash flow statement. In this particular case, we have all the inflow or outflow of a particular cash. And from all this movement of inflow and cash flow, whether the working capital is increasing or decreasing, it will make the cash flow statement. Then we summarize all the changes in a cash position of a business, which is in between the two balance sheets. In the, for example, we are making the financial statements and the cash flow statement for the year ending 2023, that will be ending on 31st March 2024. So we make the cash flow statement till 31st March 2024. And all the inflow and outflow of a particular cash will be shown in that particular statement. And in the cash flow statement, whether it is for cash balances and it is for bank balances, both will be come under the cash flow statement. Now we will check about the sources and uses of cash. So in the case of sources of cash, it includes cash from operations, issue of shares, issue of debentures, long-term loans that will be raised, sale of fixed asset. Then we have application uses of cash, like redemption of preference shares, redemption of debentures, repayment of loan, purchase of fixed asset, payment of dividend, and payment of taxes. Next one is how we can ascertain cash from operations. In the case of cash from operations, we have a main purpose of preparing a cash flow statement is to explain the increase or decrease in the cash balance between the two balance sheet dates, and it is prepared in the same pattern as we prepared the fund flow statement. In the fund flow statement, basically we have two columns. One is for sources of fund and one is application of fund. And in the case of operations of fund, we will check about the funds only. And we will start it from the net profit that will be adjusted to ascertain the amount of funds from operations. The funds from operations are now, sorry, are now adjusted to ascertain the cash from operation, and that particular changes in current asset and current liability during a particular year. So basically, when we are talking about funds from operations to cash from operations is necessary because it shows the working capital under this particular concept, and the operations will be based on the accrual concept of accounting, and the total sale and total purchase are also recognized as sources and uses of working capital. So basically, whatever we are taking it, like a cash sale, receipt from debtors, are also treated as sources of cash, while cash purchase and payments to creditors are regarded as uses of cash. So basically, in that way, we can basically make a cash from like this. First of all, we have opening debtors as on 1st 2020. 40,000, then we add the sale during a particular year, then we deduct the closing debtor, then we get cash from sales during a particular year. So basically, the same result will be obtained while we subtract the increase in debtor from the sale during the year as shown here under. Like sale during the year 2024 lakh, then we deduct increase in debtor during the year, that will be closing stock minus opening stock, that will be 10,000, and we get the cash from sale during the year, that will be 3,90,000. So when we are calculating cash from operating or operations, we can calculate from the particular equation that we have net profit, then we add opening debtor at the beginning of the year, then we deduct the closing debtor at the end of the year. Or we have a cash from operations equals to net profit added decrease in debtor, then we deduct the increase in debtor. So similarly, when we are basically calculating it from the creditor's point of view, we have net profit added increase in creditor and deduct decrease in creditor. So cash from operations will be net profit plus opening stock, then we deduct the closing stock, or net profit plus decrease in stock, then we deduct the increase in stock. If we are talking about the expenses, so in that particular case, cash from operations is equal to net profit added decrease in prepaid expense and accrued incomes, then we deduct the increase in prepaid expenses and accrued incomes. That will be discussed and maybe summed up as an increase in current asset and decrease in current liability, and that will be effect of decrease in cash from operations and decrease in current asset, and increase in current liability will have the effect of increase in cash from operations. So like in this illustration, when we have cash from operation from the following activity or information, they give us a particular P&L account for the year ended 31st March 2020. So first of all, we have purchases, we have wages, we have sales, we have gross profit, salary, rent. Then we get profit on sale of building. Then we have depreciation on plant, loss on sale of furniture, goodwill written off. Then in the end, we have net profit. So we have additional informations like balances as on 31st March to 2019 or 31st March 2020. So the opening stock and the closing stock, like stock, debtors, creditors, bill receivable, outstanding expense, bill payable, prepaid expenses. We need to calculate the cash from operations. So while we are calculating cash from operation, first of all, we have net profit as per P&L account. That will be 11,000 given in the question. Then we add non-cash items like depreciation on plant, loss on sale of furniture, goodwill written off, increase in creditor, increase in outstanding expense, decrease in prepaid expense. That will total will be 15,000, and then net profit will be 11,000. So total which we get will be 26,000. Then we deduct non-cash items, that is items which do not result in inflow of cash, profit on sale of building, so then we deduct non-cash items which do not result in inflow of cash, like profit on sale of building, increase in stock, increase in debtor, increase in bill receivable, decrease in bill receivable. Then we have outflow of cash from operations, that will be in a unfavorable, that means a negative balance of rupees 8,000, and this is our basically outflow. It shows a outflow, not a inflow. When the answer comes in a negative form, that will be known as the outflow of cash from operations instead of inflow. Next, preparation of cash flow statement. In this, basically, it is a vertical form of cash flow statements in the year ending. So first of all, we take the cash balance, then we add all the sources of cash, then we deduct uses of cash, and in the end, we have cash balance. In the account form, when we make a cash flow statement in the account form, we have two sides. One is debit and one is credit. In the basically credit, sorry, in the case of debit side, we have opening cash balance, cash from operations, and in the credit side, we have redemption of shares, redemption of debentures, repayment of long-term loan, purchase of fixed asset, payment of tax, payment of dividends, and cash balances. Now, the regulations relating to cash flow statements. First of all, that we have a accounting standard 3 for it and the Indian accounting standard 7 for it, basically. And a particular enterprise we need to follow whose equity and debt securities are listed on a recognized stock exchange in India, and enterprises that are in the process of issuing equity or debt security that will be listed on a recognized stock exchange in India, as evidenced by the board of directors resolution in this particular regard. And all other commercial, industrial, business reporting enterprises whose turnover for the accounting period exceeds rupees 50 crore, that particular enterprises need to maintain the cash flow statements. And according to the ASP of ICIO, they will took a long time for the introduction of cash flow statement, and the SEBI had formed a group consisting of representatives of SEBI and the stock exchange. ICI needs also incorporating cash flow statement in the annual report of a listed company. So basically, if we are talking about the clause that will be given by the SEBI stock exchange, they amend the clause 32 of the listing agreement, and it says that the company will supply a copy of a complete and full balance sheet, P&L account, and the director reports of each shareholder. And upon application to any member of the exchange, the company will also give a cash flow statement along with balance sheet and P&L account. The cash flow statement will be prepared in accordance with the annexure attached hereto. So the cash flow statement as a required or a requirement in the listing agreement has been made effective for the accounts prepared by the companies and listed entries from the financial year 1994 to 95, and the cash flow statement as a requirement of the listing agreement has been made effective for the account prepared by the company that will be listed in a stock exchange from the financial year 94 to 95. Now the cash flow statement formats. First of all, IAS 7 give us a indirect method and a direct method. So first of all, we see the indirect method. In that case, the cash flow from operating activity, first of all, we have the net profit from tax and extraordinary items, adjustments for depreciation, foreign exchange, investment. Then we have operating profit before working capital changes. Then we have adjustment for trade and other receivable, inventories, trade payable. Then we have a cash generated from operations. Then that deduct interest paid, direct tax paid. Then we have cash flow before extraordinary items. We have extraordinary items, net cash from used in operating activities. Then we have cash flow from investing activity. In this, we have purchase of fixed asset, sale of fixed asset, acquisition of companies, purchase of investment, sale of investment, interest received, dividend received. In the end, we will have net cash used in investing activity. Third one is cash flow from financing activity, that will be proceed from issue of share capital, proceed from long term borrowing, that will be net, repayment of financial lease liability, dividend paid. Then we have net cash used in financing activity. And in the end, we have net increase in cash or cash equivalent. In the case of direct method, first of all, we have cash receipt from customer. In that case, we have cash sale during the year and credit sale during the year. Then we add all the debtors at the beginning and basically bill receivable at the beginning. Then we have sundry debtors at the end, bill receivable at the end, cash receipt from the customer. Then we have cash paid to supplier and employees like cost of goods sold or operating expense. Then we add the sundry creditors at the beginning, bill payable at the beginning, outstanding expenses at the beginning, stock at the end, prepaid expenses at the end. Then we deduct sundry creditors at the end, bill payable at the end, stock at the beginning, prepaid expenses at the beginning, and cash paid to supplier and employees. So in this case, we have cash flow items and methodology. When we check the cash flow items like cash collection from customers, we, in the case of methodology of sale, we deduct the increase in account receivable and add the decrease in account receivable. When we are talking about cash paid to supplier, that will be cost of goods sold. So we deduct decrease in inventory and add increase in inventory. Next one is cash paid to employees. In that case, salary expenses. We deduct increase in accrued outstanding salary payable. Then we add decrease in accrued outstanding salary payable. Then we have cash paid for other operating expenses, like we deduct depreciation and other non-cash expenses. We deduct decrease in prepaid expense. We deduct increase in outstanding operating expense. Then we add increase in prepaid expense and we add decrease in outstanding operating expense. In the case of cash paid and received for pay interest, net interest expenses will be expense income. We decrease increase in outstanding interest and decrease in outstanding interest. Then we increase in interest receivable and decrease add decrease in interest receivable. Then we have cash from dividend or other sources. In that case, we have dividend or other incomes. Then we add basically decrease in other income receivable and we deduct increase in other income receivable. In the case of cash paid for taxes, we have tax expenses. We deduct increase in deferred tax liability, add decrease in deferred tax liability, decrease in we deduct a decrease in deferred tax asset. Then we add increase in deferred tax asset. Then we deduct increase in tax payable. Then we add decrease in tax payable. Then we deduct decrease in prepaid taxes and we add increase in prepaid taxes. So like this, we will make the total cash flow statement and this is the performa of your basically indirect method. Please just check this once, check this performa once. I hope this will be understandable for you, this performa of indirect method of the cash flow statement.
Yes, ma, is understand.
Next one is your cash flow from operating activities if you need to calculate. So like this, you will get a question in your basically exam. This is your cash flow summary. First of all, you will have 2021, 19, 20, and 18, 19. You are having a 3 years of data. First of all, you have cash and cash equivalent at the beginning of the year. Then you have a net cash from operating activities, investing and financing. And in the end, you have increase or decrease in cash and cash equivalents at the end of the year. Like first of all, you need to calculate from operating activity. So you will have the net profit before tax and extraordinary items, then the adjustment for depreciation, then interest, net, dividend received, PNL on sale of asset, PNL on sale of investment, then provisions, PNL and Forex, others, then you have a opening profit before working capital changes, then adjustments for trade and other receivable, inventories, trade payables, loan and advances, direct taxes which we need to pay, cash flow before extraordinary items. Then we have extraordinary items like gain on Forex exchange transaction. And in the end, we have net cash flow from operating activities. Then we need to calculate from investing and financing activity. So in the case of investing activity, we need to check what basically investment we have done. So for that, we can have a purchase of fixed asset, sale of fixed asset, financial and capital investments like purchase of investment, sale of investment, investment income, interest received, dividend received, and investment in subsidiaries, net cash used in investing activities. Then we have a cash flow from financing activities, that will be the proceeds from issue of share capital, dividend paid, and others. Then in the end, we have net cash used in financing activities. So we will see the illustration. First of all, we have a P&L account as on 31st March 2021, and we have a balance sheet on 31st March 2021. From this, we need to basically solve a question. From the direct method, first of all, we need to calculate the operating activity like cash collection from sales. We have, then we deduct cash paid for raw material, direct labor, overhead. Then we deduct, so we can deduct the cash paid for non-factory cost like salary and wages, other sales and administration, cash generated from operations. Then we have, we need to add the interest that will be earned. And in the end, we have net cash from operating activity. In the B1 investment activities, we have purchase of plant asset. Then we have short term investment. Then we can add interest earned. And in the end, we have net cash flow from investing activities. Then we have financing activity, in which we have basically cash at the sorry, in the financing activities we have dividend paid, and we only the dividend paid we have. Then we have a net change in cash from all three of activities. Then we add the cash at the beginning of the year, and then at the end we get the cash at the end of the year. Then we can have the cash flow statement under indirect method as per listing agreement. So in the operating activities, first of all, we have profit after tax or net income, then adjustments for depreciation, then trade receivable, inventories, income tax, account payable. Then we have net cash from operating activities, then investment activities. Then we have purchase of plant asset, short-term investments. Then we have net cash from operating active investments. Then we need to calculate from investment activities. It is same as the above, and in the case of financing activities, it is also the same. And the answer, whether you are calculating it from the direct method or from indirect method, it will be same. जी वो 23 और 24 के लिए हो गई है शायद, क्या नाम है, सोमिता मैडम आप। So in the end, we have net cash in net change in cash, and then we add the amount which we have in the beginning and at the end. So like this, we need to basically solve the numericals in the exam. In some questions, you will also see the additional information. That additional informations can also be given, and you need to follow these additional informations also relating to the balance sheet and P&L account. Like this, you need to do a working notes. You can show in your answer sheets, like cash receipt from customers you need to calculate. Then in that particular thing there is a sale, then you need to add the sundry debtors at the beginning and deduct the sundry debtor from the add. In the case of supplier and employees, you have cash of sale, in which you add the administrative and selling expense, add opening creditors, add inventories at the end, then we deduct creditors at the end, then we have the opening inventories. In the case of income tax paid, you will have tax paid, that will be including tax deducted at source from dividends received. Then you need to add tax liability at the beginning and deduct the tax liability at the end. Like this, you can calculate the repayment of long-term borrowing. In that case, you can add the long-term, in the starting the opening balance of the long-term debt, then you need to add which is in the during, then you deduct the long-term debt in the end. Then you have interest paid. Then in that case, you will have the interest expense for the year. Then you add the interest payable at the beginning and deduct the interest payable at the end. In this way, you can make basically the cash flow statement from the indirect method. Or like operating, you will have investing, you have financing, you have, and in the end, you have the cash and cash equivalent. Now, what are the uses of cash flow statement? Changes in the cash balances between 2 points of time and the contributing factors for such changes are clearly revealed from the help of cash flow statements. And cash flow statement also explain the reason for the presence of very low cash balance and in spite of huge operating profit, or the presence basically the presence of the higher cash balance in spite of a very low level of profits. Then you have a projected cash flow statement which will help the management in short term planning and several other ways, like determination of additional cash requirements during a given period and making timely arrangement. Then identification of the size of surplus and the time for which each surplus funds are likely to be available. Then judging the ability of the firm to repay, redeem debentures, preferences. Then you need to examine the possibility of maintaining and increasing dividend, assessing the capability of finance replacement of fixed asset, assessing the capacity of the firm to finance expansion. Then it will be more sufficient and effective management of cash flow. Now the distinction between the cash flow analysis and the fund flow analysis. Basically, fund flow analysis deals with the change in the working capital position between two balance sheet dates, whereas the cash flow statements only concern the change in the cash position. Cash flow analysis is more useful as a tool in short-term financial planning, whereas fund flow analysis is more useful in long-term financial plannings. An increase in current liability or decrease in current asset or other than cash, it will result in an increase in cash, whereas such changes result in decrease in the net working capital. Similarly, a decrease in any current liability or an increase in current asset other than cash, it will result in a decrease in cash, whereas such changes increase in the net working capital. Then there is a cash flow statement which recognizes cash basis of accounting, whereas fund flow statement is based on accrual basis of accounting. Cash flow analysis explains only the causes of cash variation, whereas fund flow analysis discloses the causes of overall working capital variations. So this is your unit 8 from block 2. The whole cash flow statement. In this, basically, you need to practice the illustration which is given you, and you can also log into the CFT portal, cftedu.in, from where you can have basically in the next, let's check what we need to study in the next block. Holding.
Hello, ma. I'm sorry for the interruption.
Yes,
Hello, ma.
it's okay.
I'm sorry for the interruption. Can you please repeat the name of the hotel?
Okay, I'll actually,
Can you
I
please
am
put
writing it in the basically chat box.
okay.
I'll show you basically how you can, just give me 2 minutes. So basically, this is the portal. Actually, CFT stands for Center for Future Technology. EDU is for education.in. Like this is my one, I am showing it to you. And this is how we have different blocks and different PPTs for it. So, for example, we have a block 1 of corporate accounting. Like this, you can have the important topics, important things. Instead of reading all the basic theories, you can just check from here, from these PPTs. You are able to know the important points. Like the thing which we have already studied today, final accounts. So see, like which we already studied in it gives you important topics like cash flow statement versus other financial statement. Then you have an important topic like preparation of cash flow statement, uses of cash flow, and then the distinction. And in a summary also they give you illustration also in this, from where you can easily understand the topic. Direct method, indirect method, they just show you each and everything in the PPTs. So from here you can study all the things in a concise way. Instead of just reading the whole book, you can just read all the important topics from here. Is it okay? Oh.